Welcome back for another report for the oil market. WTI continued to rise in the past 2 weeks, and it's characteristic that WTI prices reached a high level not seen since 2014, near $76.50 on Tuesday. Supply and demand correlation for the oil market may entice traders to shift their attention further into the greens, yet some stabilization seems to be taking place. At least temporarily, the market may pause to consider whether the commodity is overpriced or not. This report will overview the latest developments within the oil market and our personal views in parallel. We will be closing with WTI's technical analysis with important trends and levels identified. Making a start, as usual, with the weekly oil market readings and any possible assumptions we may draw. The most recent weekly Baker Hughes oil rig count figure rose from previous 411 to 421, which could imply that production levels are rising as the number of active oil rigs in the US is picking up. On Tuesday, the AP weekly crude oil stockpiles indicated a substantial ballooning of inventories at 4.127 million barrels, which came out as a surprise given that another drawdown was expected. A similar picture, yet not so intense, was delivered on Wednesday, as the EIA crude oil inventories also displayed a rise of inventories, albeit minor, at the level of 131,000 barrels. The situation seems to imply that the rise of production levels in the US may have met or even surpassed demand in the past week. Should crude oil inventories continue to rise, we may see some bearish tendencies for oil prices, as they would imply that the slack in the US oil market seems to widen. Moving away from the US, we would like to make a note regarding the headlines that surfaced about OPEC's intentions. Media sources reported that the OPEC Plus group may keep the existing deal to add only 400,000 barrels per day to its production levels for November. It should be noted that oil prices have reached very high levels in comparison to the past few years, while there seems to be pressure from the market for more supplies. Statements made by OPEC Secretary Baquinto after OPEC's Joint Technical Committee on Wednesday tended to confirm the scenario. Should OPEC restrict the increase of production only to the agreed levels mentioned, we may see bullish pressures building up for oil prices if demand is actually higher. On the demand side, Chinese provinces are reported to proceed with a rationing of electricity to maintain fuel stocks. The measure seems to have been taken in expectations of high fuel prices in the winter months, when demand is expected to rise further. The situation has created power outages at various areas of China, while power seems to be diverted to critical industries and homes. It should be noted that such actions could ease demand levels, given that China is the second largest consumer of oil after the US, easing the bullish pressures on oil prices. Nevertheless, it should also be mentioned that China uses also coal and natural gas for fuel. Overall, though, we would have to note that there seems to be an energy crunch also in the UK. It's characteristic that in the UK some petrol stations run dry, as there seems to be a shortage of lorry drivers to actually transport the fuel to the stations. The situation was further intensified by panic buying, while the UK government seems to divert fuel from large firms to pumping stations. Such actions could tame oil bulls, as could high oil prices tame demand for the commodity, as it would become less affordable, thus leading to a rebalancing of the market. Moving now to our technical analysis in WTI's 4-hour chart, WTI prices have continued to rise since our last oil report, breaking the 73.5 resistance line, now turned to support, and continued even higher, testing the 76.40 resistance line, reaching a new record high since 2014. We tend to maintain a bullish outlook for the commodities prices as long as it remains above the upward trend line guiding WTI prices since the 23rd of August. It should be noted that some stabilization seems to take place though. The RSI indicator below our 4-hour chart is currently at 58, which could imply a slight advantage for the bulls, while the price action is still below the upper Bollinger Band, implying that there is further room for advancement. Should the bulls actually maintain control over the commodities direction, we may see WTI's price breaking the 76.40 resistance line, which blocked its ascendance on the 28th of September, with the next possible targets being placed around the 79 and 82 resistance levels. On the flip side, should the bears say enough is enough and take over, we may see the commodities price breaking the 73.5, which reversed WTI's downward movement yesterday. Should the selling interest continue, WTI's price action could break the prementioned upward trend line, signaling a reversal of the market trend, and take aim for the 70.20 support level, which provided support for WTI prices on the 20th to the 21st of September. Lower than that, we note the 67.40 level, which served the pair well numerous times from the 26th of August to the 9th of September. From all of us here at IronFX, best wishes for solid trading.